There is a number that most retirees are terrified to calculate, and I understand why. It is the number of years your money has to last once the paycheck stops. If you are 65 today, the average life expectancy says you have about 20 more years. But here's the thing about averages. They are useless when it is your money on the line. Half of people live longer than the average, some live a lot longer. If you make it to 65 in reasonable health, there is a solid chance you will see 85, maybe 90, maybe 95. And every single one of those years costs money. Food costs money. The roof costs money. The grandkids' birthday cards cost money. The question that keeps people up at 3 in the morning is not whether they have enough money for this year. It is whether the money will still be there in year 17, year 22, year 28. That question is what this entire video is about. Not picking stocks, not chasing some hot investment trend, building something that pays you for the rest of your life, no matter how long that turns out to be. My name is Caleb White, but everybody calls me Bell. I spent almost 2 decades in the finance world, and I have watched the retirement landscape shift under people's feet. The old playbook does not work anymore. The pensions that our parents counted on have largely vanished. The interest rates that used to make bonds a no-brainer were non-existent for years and are only now starting to behave again. The rules have changed, and most people are still playing by the old ones. Now, before I go any further, let me say this clearly. I am a guy sitting in front of a camera sharing what I have learned. That is it. I am not your financial advisor. I am not a fiduciary. I am not managing your money. Everything in this video is for educational purposes. Take it with a grain of salt. Do your own research. Talk to a real professional before you make any major moves. Do not blindly follow a YouTuber, even one with a friendly demeanor and a clean shirt. That is just being a responsible adult. All right, let us get into it. The problem is straightforward. For most of the 20th century, if you worked at a big company for 30 years, you walked out the door with a gold watch and a pension check that showed up every month until the day you died. That deal is mostly gone. According to the Bureau of Labor Statistics, only about 15% of private sector workers now have access to a traditional defined benefit pension. 15%. The other 85% are on their own. They have been handed a 401k, maybe an IRA, and told, good luck. It is like being handed a box of lumber and a box of nails and being told to build your own boat. Some people are handy. Most people just want the boat. The result is that millions of Americans reach retirement age sitting on a pile of money, which sounds like a good problem to have, and it is, but it is also a terrifying problem. Because a pile of money is finite. Every dollar you spend is a dollar that is not coming back, and you do not know how many years you need to spread that pile across. Spend too much, you run out. Spend too little, you live like a monk for no reason, and your heirs get a nice surprise while you spent your golden years eating canned soup. Neither outcome is great. So what do? The financial industry has an answer, of course. They call it the 4% rule. The idea is that you can withdraw 4% of your portfolio in the first year of retirement, adjust that amount for inflation every year after, and have a high probability of not running out of money over a 30-year retirement. It comes from a study done in the 1990s called the Trinity Study, and it has been debated, tweaked, and argued about ever since. The 4% rule says if you have $1 million saved, you can spend $40,000 in year 1, then $40,000 plus inflation in year 2, and so on. It is a fine starting point. But let me tell you what the 4% rule does not do. It does not guarantee anything. It is based on historical market returns, and as every mutual fund prospectus is legally required to say, past performance does not guarantee future results. The 4% rule also does not tell you what to sell when the market drops 30%. It does not tell you how to sleep when your account balance gets cut in half. It is a rule of thumb, not a plan. What I want to talk about today is a different approach. Not necessarily better in all circumstances, but different, and for a certain kind of person, far more peaceful. I am talking about creating your own pension. Building a guaranteed stream of income that hits your checking account every single month, regardless of what the stock market is doing, regardless of what is happening in Washington, regardless of whether we are in a bull market or a bear market, or some sideways mess that nobody can name. Income you cannot outlive. That is the holy grail of retirement planning, and there are actually several ways to get there. The first and simplest way is also the one most people overlook because it is right under their nose: Social Security. I know, everybody knows about Social Security, but knowing about it and optimizing it are two very different things. The difference between claiming at 62 and claiming at 70 is roughly 77% more in your monthly check. 77%. That is not a typo. If your full retirement age benefit is $2,000 a month, claiming at 62 drops it to about $1,400. Waiting until 70 bumps it to about $2,400. That is $1,000 a month difference for the rest of your life. And here is the part that really matters. That higher benefit is also the base for all future cost of living adjustments. So the gap actually widens over time. Every year you get a raise, the person who waited gets a bigger raise in dollar terms than the person who claimed early. Now, I know what some of you are thinking. What if I die early? What if I wait until 70 and then get hit by a bus at 71? It is a fair question. It is the question that keeps people claiming early. But here is the flip side. What if you live to 92? What if you live to 97? The risk of dying early is real, but the risk of living longer than expected is also real, and it is the one nobody wants to plan for because it feels optimistic. Planning to live a long time is not optimistic. It is prudent. It is the base case. The people who designed Social Security did not set it up to punish early claimers or reward late claimers. They set it up to be actuarially neutral. But that neutrality assumes average life expectancy. If you are in decent health and your parents lived into their late 80s or 90s, waiting is probably the better bet. The second way to build your own pension is something called an income annuity. Now, I can already feel some of you tensing up. Annuities have a bad reputation, and some of that reputation is earned. There are some truly terrible annuity products out there, loaded with fees, complicated beyond belief, sold by people who earn massive commissions. But there is one specific type of annuity that is simple, transparent, and actually serves a purpose. It is called a single premium immediate annuity, or SPIA. I will explain how it works because it is so simple it almost sounds like a trick. You give an insurance company a lump sum of money, let us say $100,000. In exchange, they promise to send you a fixed monthly check for the rest of your life. That is it. You know exactly how much you are giving them, and you know exactly how much they are giving you back every month. There are no hidden fees. There is no market risk. There is no complicated investment strategy. You hand them a pile, they hand you a stream. The insurance company is betting you will die sooner than their actuarial tables predict. You are betting you will live longer. It is the only bet in finance where winning means you lived a long life. That is a bet worth taking. How much does it pay? That depends on interest rates and your age. As of 2026, with interest rates having come up from the basement, a 65-year-old man putting $100,000 into a SPIA might get somewhere around $600 to $650 a month for life. A 70-year-old might get closer to $700 or more because the insurance company expects to make fewer payments. A woman might get slightly less because women statistically live longer. These are ballpark numbers. You have to shop around. But the point is that a portion of your savings can be converted into a guaranteed paycheck that never stops. It is the closest thing you can get to an old school pension without actually having one. Now, the objection I hear most often is this. But Bell, if I give them $100,000 and I die in year 2, the insurance company keeps the money. That is true with a basic SPIA. It is the trade-off. You are giving up the lump sum in exchange for the guarantee. But there are ways to mitigate that. You can buy a SPIA with a cash refund option, which means if you die before getting your full principal back, the remainder goes to your heirs. You can buy a period-certain SPIA that guarantees payments for 10 or 20 years, even if you die sooner. These options reduce the monthly payout slightly, but they protect against the die-early scenario. For a lot of people, that is worth the trade. The third way to build guaranteed income is through bond ladders. This one takes a little more work, but it is completely under your control. Here is how it works. You take a chunk of money, let us say $200,000, and you buy a series of bonds or CDs that mature at different dates in the future. A bond maturing in 2027, another in 2028, another in 2029, and so on, out to 10 or 15 or 20 years. Every time a bond matures, you get your principal back, and you use that money to cover your living expenses for the next year. The interest payments along the way provide additional income. The beauty of this approach is that you are not relying on the stock market for your basic needs. The money you need for groceries in 2032 is sitting in a treasury bond that matures in 2032. It is not subject to a market correction. It is not going to disappear in a crash. It is just sitting there, guaranteed by the full faith and credit of the United States government. Bond ladders have become a lot more attractive in the last couple of years because interest rates are no longer at rock bottom. You can actually earn a real return on bonds now. Treasury bonds maturing in 10 years are paying over 4%. That is real money. A $200,000 bond ladder at 4% throws off $8,000 a year in interest, plus your principal comes back to you on schedule. It is predictable. It is boring. And boring is beautiful in retirement. The fourth approach is dividend-paying stocks. Now, I need to be careful here because stocks are not guaranteed. Let me say that again. Stocks are not guaranteed. Dividends can be cut. Companies can go bankrupt. The share price can drop and drop hard. But a portfolio of high-quality dividend-paying stocks from companies that have been increasing their dividends for 25 or 30 or 50 consecutive years, what are called dividend aristocrats or dividend kings, has historically provided a growing stream of income that outpaces inflation over time. Think about companies like Procter & Gamble, Johnson & Johnson, Coca-Cola. These are not exciting companies. They are not going to double in a year, but they sell things people buy regardless of the economy. Soap, Band-Aids, soda. And they have been sending dividend checks to their shareholders for decades, raising those dividends almost every single year. A dividend portfolio is not a replacement for a pension. It is a complement. It provides income that can grow over time, which helps fight inflation. A SPIA payment is fixed. A bond ladder payment is fixed. Social Security has cost of living adjustments, but your other guaranteed income sources do not. Dividend growth stocks can fill that gap. The key is to own them outright, not through some expensive product, and to focus on the dividend checks, not the daily price swings. If the market drops 20% but your dividends are still being paid and even growing, you are fine. You do not have to sell anything into a down market. That is the magic of living off dividends. The fifth approach is real estate, specifically rental property. This one is not for everyone. Being a landlord is a part-time job. Sometimes it is a full-time headache. Tenants call at 2 in the morning because the toilet is overflowing. The roof needs replacing. The property taxes go up. It is not passive income. Anyone who tells you rental property is passive income has either never owned rental property or is trying to sell you something. But for the person who is willing to do the work or hire a good property manager, real estate provides two things: monthly cash flow from rent and a hard asset that tends to appreciate over time and keep pace with inflation. A paid-off rental property generating $1,500 a month in net income is functionally equivalent to a pension that also comes with a big pile of equity you can tap if you ever need to. The sixth and final approach I want to mention is the one that ties everything together. Most people should not use just one of these strategies. They should blend them. Social Security is the base layer. A SPIA or bond ladder provides the next layer of guaranteed income. Dividend stocks and real estate provide growth and inflation protection. Together, they create a system where your basic living expenses are covered by guaranteed income, and your discretionary spending comes from the growth assets. That means when the market crashes, you do not have to sell. You just wait. Your bills are already paid. The market eventually recovers, as it always has, and your growth assets continue doing their job. Let me give you a real example. I'm going to call this couple Bill and Linda. Bill is 67. Linda is 65. They have saved about $800,000 in their IRAs and 401ks. They also have a paid-off house worth about $350,000. Their Social Security benefits, combined, are about $3,800 a month. Bill and Linda want to travel a little, spoil the grandkids, and not lie awake at night watching CNBC to see if their portfolio is still intact. Here is one way they could structure things. They take about $250,000 of their savings and build a treasury bond ladder stretching out 10 years. That ladder generates about $10,000 a year in interest, and every year, another bond matures, giving them back roughly $25,000 in principal. They take another $150,000 and buy a SPIA with a cash refund option, which pays them about $900 a month for life. The remaining $400,000 stays invested in a mix of dividend stocks and a broad market index fund. What does their monthly income look like now? Social Security is $3,800. The SPIA is $900. The bond ladder interest is about $800 a month. That is $5,500 a month in mostly guaranteed income before they even touch the growth portfolio. That covers their basic living expenses with room to spare. The $400,000 in stocks can grow undisturbed. In good years, they can skim off some gains for a nice vacation. In bad years, they leave it alone. Bill and Linda have not eliminated market risk entirely, but they have walled it off from their day-to-day life. They know their bills are paid. They know the checks will keep coming. That knowledge is worth more than an extra percentage point of return. Now let me address the elephant in the room: inflation. Every retiree's silent enemy. It is the reason a dollar today will not buy what a dollar bought 10 years ago, and 10 years from now it will buy even less. A fixed pension payment, a fixed annuity payment, these are vulnerable to inflation. If you lock in $650 a month from a SPIA today, that $650 will still be $650 in 2040, but it will feel more like $350. That is the trade-off. That is why you do not put everything into fixed income. You keep some growth assets. You keep Social Security with its cost of living adjustment. You might even buy a small SPIA now and another one in 10 years to layer in additional income at higher age-based payout rates. There are ways to manage inflation risk, but the first step is acknowledging that it exists and planning for it, not pretending it will go away. The biggest mistake I see retirees make is not having a plan at all. They retire, they have a pile of money, and they just start spending. A little here, a little there. Maybe they sell some stocks when the market is up. Maybe they panic and sell when the market is down. They have no system. That is like driving across the country without a map and hoping you end up somewhere warm. Maybe you will. Maybe you will end up in North Dakota in January. Having a system, knowing where your income is coming from, knowing that your basics are covered no matter what, that is what lets you enjoy retirement instead of worrying about it. Let me bring this all together. The old pension system is mostly gone. Nobody is coming to save you. The government is not going to mail you a bigger Social Security check out of the goodness of its heart. Your former employer is not going to suddenly decide to reinstate the defined benefit plan they froze in 2003. You are the pension manager now. The good news is that you have tools. Social Security optimized for maximum lifetime income. A simple annuity if guaranteed income helps you sleep. A bond ladder if you prefer to keep control. Dividend stocks if you want growth. Real estate if you want a hard asset. These are the building blocks. You mix and match based on your situation, your tolerance for complexity, and what helps you sleep at night. I have seen too many people enter retirement with a healthy nest egg and still feel poor because they are terrified to spend it. They have no paycheck, so they treat their savings like it is the last barrel of water in a desert. That is no way to live. The whole point of saving for 40 years was to spend the money. A guaranteed income stream gives you permission to spend. It tells you exactly how much is coming in every month, and it tells you that number will not change. That is freedom. That is what a pension always provided. It was never just about the money. It was about the certainty. If this video got you thinking, hit that like button. It helps more people find this channel, and it tells me you want more content like this. Subscribe if you have not already. I put out videos every week on how to navigate this retirement landscape without getting lost in the weeds. And share this with someone who is approaching retirement or already in it. A friend, a sibling, a neighbor who just sold his business and is not sure what to do with the proceeds. The rules have changed, and most people do not even know the game has been updated. You can be the one who helps them figure it out. My name is Bell. Thanks for watching. I will see you in the next one.